You're watching Stock Watch. I'm Zinati Guma, and join me to unpack your stock-related questions today are Pierre Verster from Protea Capital Management and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. JP, did Nedbank once again drag the financial sector down with it today?
To some extent, yes. The interim results were slightly disappointing. They said they're only going to get to lower single-digit growth for the full year that they expect. And then they took a bit of a knock on the EcoBank stake as well, that they needed to revalue to fair value because now it's a discontinued operation. So they say they're in touch with a few potential buyers. So when they ultimately do sell that, probably before the end of this year, we'll see that a loss on disposal come through. And other than that, obviously a big reorganization as they effectively split the personal and business bank and the wealth business more into a division that's focused on individuals versus a division that's focused on businesses. So a lot is going on in Nedbank. And while it's disappointing that the growth won't get to double digits, it's still very cheap. It's trading slightly below the book value per share of the bank. So at that valuation, I think your downside is relatively limited, and there could be upside if we have some spark of growth in the economy that could hopefully in the next few years get them back to high single digit, if not double digit earnings growth per share.
Well, that's the thing, because there was a lot of emphasis on the worse than expected performance of the South African economy. And I do understand that there are certain things that they are doing internally. But Ricus, someone actually asked me, I wonder if this is maybe a signal of a softer kind of earnings season for the banks specifically, and maybe Nedbank is providing a signal, or is it just, do you think that it could just be contained to Nedbank?
No, I think it's broader banking as well. If you just take a look at Nedbank's numbers, their interest income, which is what, in the end a bank does, was disappointing. Most of the growth they got was from things which are not to do with the banking business. And I don't think that's only a Nedbank problem. I think it cuts across the other banking groups as well. And frankly, it's similar to what's happening with American banks, where the business besides banking are pulling up those numbers, whereas interest income growth is pedestrian, to say the least.
All right. Well, before we actually get to the questions, because there's another one that surprised me today. Telkom just kept on tumbling and tumbling and tumbling. I think they ended off the day down 10%. And I mean, JP, this has been a stock that has performed really, really well. Also coming out with a trading statement, I don't know, to me it didn't look too bad. What did you get out of that one?
Correct. The trading statement was not too bad. You've got some low single-digit EBITDA growth. The balance sheet is in a better shape after they sold some properties. BCX was the only real blotch on the result, but it's a relatively small division, so the overall group results were solid. But to your point, Zinati, the share price has done a lot. It is, I think, just about doubled over the last year, a little bit more if you go back a little bit further. So expectations were high. And maybe people were too negative, this telecommunications business, when it was trading in the mid-20 Rand region per share. But maybe they got a bit over-optimistic and thought it was a growth business, a high-growth business, up until yesterday. And today those expectations needed to come down to meet reality. So definitely not a bad performance. It's just that the expectations, in my opinion, from the market, from shareholders, were too high.
Yeah. And actually a lot of people had then been asking, because we've seen this rally, and people had been asking if, it's too late to nibble into Telkom. I don't know, Ricus, would you be seeing the softness as an opportunity to go in for those who maybe missed the boat earlier? Or is it a case of maybe it just will not produce the numbers that people want?
Yeah, I think, a similar thing happened with the Vodacom share price on its release. It wasn't a bad result, and as JB said, the operational trading update from Telkom was pretty good. But I mean, Telkom's share price since the start of the year is up 80%. So giving back 10% just tells you that the market was expecting too much from the company specifically, and possibly the sector as well. I wouldn't jump in right now, a day after, because you've missed the boat over the past year. Let's see where it settles. I still think Telkom is well, it's way down the road as far as recovery in its operations are concerned, but it can do some more. And certainly, if we do get a price weakness just on profit taking over the next month or so, it will come back into viable range.
All right. Well, let's get into the questions. JP, you actually chose Adcock Ingram as a stock pick. What was it, last week? So this question goes, is the current minority share offer fair? I recall more than 10 years ago, it was deemed above 72 Rand per share when foreigners wished to purchase the company. Yeah, JP?
So the board's opinion of the fairness of the offer, informed by a third party that will give them a report, will be published in the circular that we are all waiting for. Now, based on the fact that it is at a significant premium to the last traded price, and it's not an offer to gain control, one should not expect, as is normally the case when these offers happen, that a control premium is implied in the offer. Because it is for a minority stake, I would say a significant premium to the last traded price would by definition be fair. And that was the case. So I expect the offer to be deemed to be fair when the independent expert gives the report. It'll be part of the circular, mainly because of the fact that we don't have the normal situation of someone buying control of this listed company, but someone buying a minority share in this listed company.
All right. Ricus, I'm going to give you another question because I think JP has settled that question. So your view, or your prepared copper producing resources stocks over a 3-year period, and there's actually been a lot of interest in copper at this point. Would you have a preferred pick there, Ricus?
Yeah, I'll stick with Billiton. I know that there's, and one can take a look at Glencore and say, well, there's a lot to gain from Glencore if, as they rectify some of the operational difficulties they've had. But I'm just sticking a little bit with safety at the moment, and therefore Billiton.
Okay. JP?
Sure. Look, if I had to buy a mine, if you say I had to, I cannot buy anything else. I have to buy a copper mine, then I'll pick Anglo American. These days, it's similar to Billiton in terms of it's mostly copper and iron ore. And with some newer copper assets coming online, I would go for Anglo American. But that's only if I really have to buy a copper mine.
Someone must force you to.
Yes.
All right. There are actually quite a few questions on, I think there's on gold. So there's Goldfields and Anglo Gold Ashanti. So let's get into Goldfields. It released a trading update yesterday. So Goldfields is printing money as per the trading update. Gold shares remain a good prospect for the next 3 months as the gold price is expected to rise to new highs. Your comment, Ricus?
Well, I don't know whether I can comment because all the facts have just been presented as a certainty. I don't know, but certainly I think there's scope for the gold price to increase even from current levels. Taking a look at national bank buying and uncertainty surrounding whatever Trump thinks he's doing or might be doing next.
Yeah.
So there still is that safe haven status, and I think gold will maintain that for as long as things remain uncertain. Then as to whether one should buy Anglo gold or goldfields if you want to buy a gold share, and maybe you should buy both. But the Anglo share price has been outperforming goldfields for a while now, and that kind of trend tends to continue. I also like the geographic spread of Anglo Gold's mines versus Goldfields. So Anglo Gold's probably, what did JP said? If somebody forces me to buy a gold share, I'll probably go for Anglo Gold.
Yeah, you're not out of this box, JP. As Ricus made a scenario of Anglo Gold versus Goldfields, this one is actually Anglo Gold versus Sibanye, because the viewer says, I have a small number of Anglo Gold Ashanti shares. The current price is giving me a good profit, but I'm thinking of selling them to buy Sibanye. Is this a good move? If not, what would you suggest?
So based on the switch that the viewer is contemplating, they are in effect saying maybe the extent to which gold has outperformed the PGM metals, that time might be coming to a close, and maybe the PGM metals will outperform gold. Yeah. And if that is the case, you would rather want to own Sibanye shares rather than your gold mining shares, because Sibanye has got significant PGM exposure. So what I would say is it depends on how sure you are that from this point forward, the PGM basket price is going to outperform the gold price. If you are very sure, you don't need to worry even about the shares. And I'm saying this now a little bit tongue in cheek. You can just buy a platinum or palladium future, and you can short the gold future. And you can make money that way if you're really sure that platinum, palladium, and maybe rhodium, there's a rhodium ETF these days, is going to outperform gold. But the key, Zanati, why I say it's tongue-in-cheek, is no one really knows in the short term which is going to do better, gold or the PGMs. In the short term, anything can happen. So be careful. But yes, if you think medium to longer term PGMs will do better than gold from this point forward, then you should switch from your gold mining shares to Sibanye shares.
More questions. There is one on Richemont, and it goes, is the Richemont a long-term buy at a PE of 24 with all the uncertainty of Trump tariffs? Of course, we know how hard the share was hit last week. Ricus?
Yeah, I took my book here because that was a stock pick, and despite being a drummer, I got my timing completely wrong on that, but I still think at current levels it's probably a buy. When compared with the other luxury groups, they've got a different market, they've got a different way of selling things. It's not as if they're not going to be hurt by tariffs, but I think it's less than their competitors. And they also have margin to play with because they didn't push margins to ridiculous levels during the pandemic, so they can play around with that as well. So they are more competitive versus their competitors. So I think long term, these tariffs will be adjusted going forward, and I think we're probably as bad as it can be as far as Switzerland's concerned. So I think the selling has been overdone.
Okay. Yeah, what 39% tariff on Switzerland? Yeah. JP, I don't know, would you be seeing this kind of, I guess, overhang on the stock maybe as a buying opportunity? Yeah, what would you be getting from it?
Look, Richemont is a high quality business, and the watches part of the business has been shrinking as a proportion of the whole business. That is the portion where Switzerland as the manufacturing base is very important. People want to buy a Swiss watch, not a Norwegian watch. So it's important that the watches are made in Switzerland. But the part of the business that has been growing stronger and is the vast majority of the profits these days is the jewelry business. And the jewelry doesn't necessarily need to be manufactured in Switzerland. So Cartier obviously is a French brand, if you think about it, even though it's owned by Richemont, the name is a French name. So a lot of what they do is not necessarily, does not necessarily originate out of Switzerland. So I think the tariff impact on them will be less than some others, especially less than Swatch, for instance. And I agree with Ricus that if you look at what they sell, mostly jewelry, it's called hard luxury. It's not mostly handbags like Hermes, for instance, sells. And the jewelry business, I think, longer term is a better business. So yes, I would look to buy Richemont shares. I don't think they're particularly cheap at the moment, but I don't think they're expensive either. They're around fair value, but it's a high quality business. So fair value is not a bad price to pay for a high quality business.
Okay. Well, sticking to retail, but at the lower end, can I buy Pepkor at current levels, also taking into account the subsidiaries, Ackermans, Incredible Connection, Bradlow's, Techie Town, and just a nice comment for you, gents. Thanks for an excellent program. I've been watching it from 2010. Pepkor, would you be buying it where it is, Ricus?
Again, talking my book because that's my major clothing retail in my portfolio. So I don't know whether I'll be buying it, but I'll be holding it.
Okay.
I still prefer it both from a technical graph point of view and from a business point of view. They are, as far as the clothing retail is concerned, I think they're in the right sector of the market. And I still like what they're doing on the financing side of things with their cell phones, etc.
JP, how much more momentum do you see without the extra factor, the overhang of the IBEX holding?
Yes, so the overhang has now been removed. I see the one credit-focused hedge fund, which bought almost 8% of Pepkor in the placement, is now down to below 5%, and they'll probably very soon be very close to zero. So a quick in and out for them. They probably got to learn of Pepkor when they did all their work on IBEX and Steinhoff back in the day and liked the business. And similarly, I like the Pepkor business. Again, a very strong, high-quality business. But we've had a few updates in the last few weeks. We spoke about Nedbank earlier today and the fact that they spoke about a difficult SA economy.
Yeah.
Similarly, the Shoprite update today, Shoprite ended down, even though the earnings guidance was strong. The turnover from Pick n Pay, not necessarily that great. Woolworths, mostly weakness in Australia, but also SA not particularly strong. So it shows you that things are tough in South Africa. Now, that will be good for a more value retailer like Pepkor. And that is why I said I would probably also still stick with it and keep my Pepkor shares. But I would just be cautious about the whole retail sector at the moment because things seem to be very tough in the local economy. The consumer is not in a happy space.
Yeah. What about the paper and packaging sector? Because things don't seem too great there as well. There's a question on Sappi. Why is Sappi's share price doing so badly and over such a long time? And Ricus, it's not just Sappi in isolation. That's Mondi as well, right?
Yeah, I think Mondi is a little bit different because of the European operations, but Sappi is indicative of what's happening in the South African industrial side of things. JP just spoke about the consumer being under pressure, but so are company costs. We've just had S&P release our Purchasing Managers Index yesterday, and input costs are up again for company, and they're in fact at about a 3-month high, and those costs are not being passed onto the consumer. In other words, companies increasing their prices. So Sappi is in the unenviable position of having its operating costs starting to eat at margins, and what they sell is not subject to inflation either. So they're getting the same or less for what they sell, and their costs are increasing, and that's why your share price is looking the way it does.
JP, yeah, what does one do with the cyclicality of this company? I mean, do you just completely stay away from it, or do you only nibble at certain times?
So it's a personal preference. You could either just stay away because you tell yourself 10 years from now, there's a chance the profitability is very similar that it is today. So between now and 10 years, the share price will probably double and double and halve and halve and double and double and halve and halve. You'll be back where you started. Or you can say, no, I want to play the cyclicality. I want to buy after it's halved and halved. And I want to sell after it's doubled and doubled. But again, that means you are very good. It means you can foresee these cycles and you can climb out at the top of the cycle and you can climb back in at the bottom of the cycle. So there is money to be made in cyclical companies because their share prices also exhibit cyclical tendencies. But it's difficult. So my preference is to either stay away or to try and short cyclical companies when they are at a cyclical high, but not to necessarily go with a big long position in a cyclical company when I think the cycle is low. If you are really good, you would do both. You'll try and short them at the top and buy them at the bottom, but very few people get both those things right.
All right. I think before we get to your stock picks, let's go into British American Tobacco. Your view on that. It came out with the results or a trading update last week and seemed that investors liked it. Ricus?
Yeah, I'm probably envious because I missed that stock completely, but it's price-wise is performing like a growth company at the moment. I think it's overdone. I think there is the benefit of a comparative valuation versus something like Philip Morris, for example, where they were undervalued and they're playing catch-up. I think there's a story to be told about the non-burn products that is also growing versus the traditional cigarette market. And I think the third aspect of this upwards price momentum is a flight to safety in general in markets. But yeah, as I said, I might be completely wrong, and there might be a lot more upside. But as far as I'm concerned, the easy money's been made in that.
And that's the thing. It's quite an interesting point that Ricus makes as well, that the share price has been behaving like it's a growth company. And I've also been surprised as well, because a lot of people have been saying it's a sunset industry. Your take on BAT, JP?
Well, there's sort of like a growth business hidden away within the group, and that is the alternative smoking products, the next generation products, whether it's vaping or heat not burn. They don't have that much chewing tobacco, but you can put the pouches maybe in that same category. While the cigarette business is a shrinking business, basically. Definitely in terms of volumes, and for a long while they could offset volume with price, but now it's getting difficult to keep that profitability. So there is a growth business in here, and all of a sudden that's what people have been focusing on the last 18 months. But still, I think now we're trading much closer to fair value when it comes to British and American tobacco shares. And I prefer some of the other big tobacco groups. I think Philip Morris still offers better value and better growth prospects. And I even like Altria. The growth prospects don't look as good, but they still have a stake in Anheuser-Busch, and it's just much cheaper. So even though you don't really have growth, your starting valuation is much better. So I would rather look to one of those two tobacco companies at these prices rather than British American Tobacco.
All right. Well, let's get to your stock picks for today. Ricus, where are you looking?
Playing for safety again, it's redefined properties listed locally, property company. It's not, shall we say, the one that stands out as the best managed or anything like that. But I think at current prices, and considering that we are seeing an inflection point as far as their industrial properties are concerned and their retail properties, office is possibly still lagging a little bit, but at current valuations, I think even with the expectation of steady income growth and a steady dividend policy, as far as we're concerned, we've got about a 15% upside in the share price and underpinned by about an 8% dividend yield. That's not a bad return in an uncertain market.
Okay. JP, where are you finding opportunity today?
I'm finding it in the US, Zanati. If you look around the world, it's still the economy that seems to be doing the best, a lot of growth. And between the big, beautiful bill and the previous CHIPS Act and whatever Trump is doing with tariffs and onshoring that's happening, there's a lot of activity and a lot of construction happening in the US, data centers and other construction activity as well. So I'm picking a equipment rental business, United Rentals. It's the biggest equipment rental business in the world. They have almost 2,000 outlets that they rent things like scaffolding and excavators and forklifts, porta potties, generators, anything you can think of. And their main clients, it's roughly half construction and industrial users. And with the US economy doing strong, a lot of construction activity, I think a company like United Rentals can do well. They only have 15% market share, even though they're the biggest player. It's a very fragmented industry, which gives them a long runway for growth, and it's not trading at too high a valuation, while a lot of other US stocks are. So for me, it's one way to still get exposure to the strong US economy, but in a share that's still trading at reasonable valuation levels relative to a lot of other US listed shares.
Awesome. Thank you so much for your time and for your analysis today, gents. Much appreciated. That's it for Stock Watch today. Thanks to our guest, Pierre Verster from Protea Capital Management and Ricus Reeders from PSG Hole in Ruimsig. Up next, the close. Stay watching.